Hey everyone, hopefully you can hear me. Hopefully it's not too loud because on Twitch it was really quiet. So maybe because I set it to be loud on Twitch, it's going to be really, really, really loud on YouTube. So um, yeah, let me know if the volume level is okay. But hopefully everything's going to work smoothly. So far it's been okay. So fingers crossed. Before I dive in, we'll go to the usual disclaimers. So obviously this is essentially a marketing material, really. None of this constitutes financial advice. I don't know your unique circumstances, so I can't advise you specifically, but obviously I'm going to run through what's been going on through the quarter with my portfolio and everything like that. So everything I share is my own opinion, not the opinion of eToro or anyone else, and certainly not advice that you should be necessarily acting upon. So I think that pretty much covers that. Obviously, if you're copying me, then you're doing so at your own financial risk. So your capital is always at risk in such situations. I'm going to hopefully get through some of these early slides quite quickly this time. Wow, I'm quite surprised that the chat thing is working, to be honest. I did not expect the little chat box at the side to work, so that's quite surprising. Yeah, hopefully I can kind of speed through the first few slides quite a lot because I'm sure that most of my copiers have seen those by now. I still keep them in there, obviously, for those people that are new to copying me. But from what I can see from the stats, most of you have been with me for a pretty good amount of time now. I think the average copy amount is approaching copy time is approaching 3 years now, and I know for a fact that there's some people that have been copying me for over 5 years. So, yeah, pretty cool stuff. As I said, obviously none of this is financial advice, so let's get stuck in with that. That being said, this is me. I'm Jay, also known as Jaynemesis on eToro. That is still my old desk. I still have not updated the photo from that. I promise one day I will. I say that every time, and I will continue to say it until one day I actually do. Yeah, the photo at the bottom is me with Yoni. He's the CEO of eToro. That was in London. So after COVID kind of ended, there was a big popular investor meetup in London. It was really cool. Loads and loads of people there, like 200 or so people. So yeah, that's why I put that picture there. I met loads of awesome popular investors there as well on eToro. I've been trading now for, I think, probably almost 15 years now. Pretty much since as soon as I was able to open an account, I did so. The first account I opened was actually a shared account with my mum because I wasn't allowed to open one on my own because of my age at the time. So that goes to show how long I've been interested in markets, I guess. I was fully self-taught. That's not entirely true anymore. I should probably change that to point out that I do have some real qualifications in this now. But to begin with, I was entirely self-taught. I'd always been interested in financial markets and in investing and business and technology and news and politics and economics, all of the things that most people at that age really don't care about. But I was a bit of a geek, so I did, and I still do, obviously. Since joining eToro, I have a compounded annual growth rate of over 30%, which I'm pretty happy with. Obviously, if you look at the likes of Warren Buffett and some of the other great investors around the world, whether it's Bill Ackman or whoever it may be, pick your favorite investor. Generally speaking, anything above 20% is deemed to be pretty good, and certainly if you're getting 30% or higher, then you're pretty much up there amongst the top. Obviously, if that's only done for 3 or 4 years, it doesn't really mean too much. But I'm now approaching 10 years on eToro now. This is my the 9th year for me. So once this year is done, I'll have a full record. I think. Or is it my 10th year? I can't remember. But I've been on eToro for a long time now. So yeah, I'm pretty pretty excited to be still maintaining a CAGR above 30%. Ethics and vision. So ethics is a really big thing for me. I really care a lot about how I invest, not just about making money. For me, it's about making money while not doing bad things, and hopefully doing good things. So yeah, ethics is something that I consider in everything I do in terms of investing. I always look at who's behind the company, what the real purpose of the company is, and ultimately if it's really a good or bad thing for society. Um, I'm also a bit of a kind of futurist. I absolutely love technology and disruptive technology. I've kind of prided myself on my ability to spot trends quite a long time before the kind of mainstream public, and that's really kind of the theme that I go with when I'm trying to invest. So I'm always looking for, whatever the latest new thing is, whether that be something like space travel or vertical farming or cryptocurrency, obviously, or electric vehicles. All of those sorts of things are the kind of things that I like to look at to try and beat the market and give myself an edge. My background before this is actually in gaming and events. I was a professional gamer for a few years. I ran Trackmania team. I played StarCraft as well for a long time, and a few other games, Command and Conquer 3. And then I went on to work in the events industry after that. So I was running big esports events, working with different gaming brands from around the world, Activision, things like that. So, yeah, quite a lot of experience in the events industry. I I guess if I were to try and if someone were to ask me how that relates to investing, I would say you have to you have to think on your feet and make decisions quickly. So, yeah, that's I guess that's the main crossover. I've been a popular investor since 2017. 2017, that's when I went full time and quit. I think I actually technically became a popular investor in 2016, but in 2017 is when I quit and went full time at it. In terms of a track record, as you can see, I've got 9 full years on eToro. So yeah, I'm pretty happy with that. My copiers are still over 18,000 copies. It's slowly been dropping recently. I think the poor performance last year and so far at the start of this year. Let's not beat around the bush. Hasn't helped particularly, but I'm still overall pretty happy with how things are going. As I said, the CAGR, that's the actual specific number. I calculated that this morning actually, just to double check it. So yeah, 33.44% is my compounded annual growth rate. So I'm still really happy with that overall, and I hope to try and maintain it. And ideally, I would like to get back above 35% again, but it's difficult at the moment. So we'll see. We'll see how things go. My lifetime return, if you had copied me from day one on eToro, is 1,342%. So that's pretty good. If you copied me with like 100,000 back then you would have been really happy. I wish I had 100,000 in my eToro account back then, but I did not. So I'm obviously motivated to still go, and I hope to continue growing that. As our investments continue to compound, the longer you're invested, the more hopefully we will make together. AUC is still over 75 million, so that's the total value of all of the money that all of my copiers have set to copy me. So it's quite a big responsibility. It means that I can't necessarily trade really small companies and things like that. I have to be mindful of the liquidity, and really kind of I think it also adds a bit more responsibility on making sure that I'm not being excessively risky in what I'm investing in. I still take risks. I'm sure many of you can probably go through my portfolio and find some examples of things that have fallen by 70% or something over the years, and that will still happen. But hopefully there'll be more that go up by a larger number than that. I said I wouldn't spend too long on these slides, but here I am waffling on. I will answer questions at the end, by the way, so feel free to kind of drop them in chat now if you like, but if you can, please don't repeat them, because I'll read the chat from the start and jump down and try and answer everything. Okay, so a bit about my strategy. As I said, I'm really kind of focused on future trends. So that's really my starting point for any investment. Really, is trying to identify things that are coming up on and are likely to occur in the future. Sometimes those things are 3 or 6 months in the future. Sometimes those things are, 5 or 10 years in the future. Generally speaking, it's somewhere between 3 and 5 years overall that I try to look at. But I often try to also kind of keep a part of my portfolio available to me if I want to adjust things and kind of hedge against shorter term risks. So things like COVID-19 would be a good example of that. Last year's drop would be a bad example of that, because although I tried, I didn't really succeed in hedging away all of the downside risk there. So we pretty much ended up slightly ahead of the NASDAQ. Which is still good, but not as good as I would like it to be. The next thing that I'd kind of go for after I've identified a theme or a trend is looking at the kind of the core product. What is the product or service that this company is engaged in? What are they building? How does it work? Why has it got an advantage? What are the competitors? So I spend quite a lot of time on that. That's one of the areas that I think I have a strong advantage, because I'm just a complete nerd. Recently learning about heat pumps, for example, I know more about radiators than I should do. I think that's one of my advantages. Again, with cryptocurrency, with solar technologies, with electric vehicles and stuff, I think that's really one of the areas that I shine quite well. Next up is fundamentals. So really looking through the financials of the company. This is also really important, making sure that they're actually on a good trajectory in terms of their cash flow, especially since I invest in a lot of growth stocks. It can be really important to make sure that they've got enough investment, enough runway to survive. So that's something that I spend quite a long time on, and then looking at the valuations. ESG is another increasingly important area for me. I say ESG, but really it's more than that. It ties in with what I said earlier about the ethics and kind of more sustainable and responsible investing. SRI is actually another term that's used a lot, but I think most people have heard of ESG more. So that's what I tend to put down, even though I'm more on the SRI side overall. But ESG is a part of that. It's complex. But ESG stands for environmental, social, and governance, and basically that means it's a method of kind of looking at companies' risk in terms of those different areas, and looking at their policies and what they're doing in those areas. So making sure that they are looking after their community and their staff really well is what the S is for, the social. E obviously is environment. So you're looking at climate change mitigation, the risk that company has in terms of climate change if they're contributing to it a lot, and things like that. And then governance, as well as looking at the management team and the kind of diversity of the company and things like that as well. And a lot of people, there's been a lot of backlash against ESG recently. So to spend just a couple of minutes, I guess, or a minute talking about it. Really, ESG is actually about risk more than anything else. So when you're looking at, for example, the environmental impact of a company and their emissions and things like that, although you can argue that it's kind of being woke and it's not necessary and it's going to cost you more money because they have to spend money mitigating those things. Really, it then comes down to the kind of risks around it. So things like the risk to their own business model if people stop buying that product because it pollutes too much. If for example, they are contributing to climate change a lot, and they're in a jurisdiction that decides to introduce taxation on that, on CO2 emissions, then that's obviously a big risk as well. And the same is true for the social side of things as well. So if you're not looking after your staff, then that gives you a bit of a disadvantage in terms of hiring. And at the moment, we know that labor markets are really tight. So companies are struggling to kind of hold that talent. So as a result, really looking at those things can be very important to make sure that companies are retaining their staff and everything else. And the same obviously is true for governance as well. There's a lot of evidence and studies that show that the more diverse a company is, and especially the board level, the better they tend to perform in the long run. So just to kind of dispel a few myths, not that I really needed to do that here, but I felt like I should do it anyway, because I think a lot of people get a bit confused about what ESG really is. Portfolio fit is next. So obviously, once I've identified, something that I want to invest in at this point, I'm generally kind of looking for reasons not to do it. And that's where I then look at the portfolio fit and make sure that it does actually complement the portfolio. Or if it doesn't, I have to think about ways to adjust the portfolio to make sure that it's a suitable thing to put in there. So really, it's looking at things like the kind of correlation with other stocks and shares and things in the portfolio. Next up is sentiment. So again, really, it's just looking at the kind of public kind of view of this company or of the products. It's not super important. I don't always do it. Sometimes it's not really necessary, and sometimes it's quite difficult to measure as well. But it's something that I do like to consider at least. And then last of all is technicals, so technical analysis, which is really just looking at the chart and the volume, momentum of the share price and trying to plan around that on when it's best to enter or exit the position. Again, this isn't something that I always necessarily do, but it's something that I like to consider and at least kind of check that I'm not doing it at a really particularly bad time. Okay, so going into Q1, portfolio themes. Again, these are kind of broad strokes. It's very hard to sort of, I guess, pinpoint exactly what the kind of core elements of the portfolio are in just kind of 6 words, really, which is what I've attempted to do here. But fintech is really the kind of new addition, I would say. I've always had a little bit of exposure to some financial stuff. I've invested quite a lot in Square in the past. I had some Square at the start of the year as well. Things like Coinbase, for example, I did some great trades on that at the start of the year. The picture there is of Intuit, which is a big kind of company that has a bunch of different software products like QuickBooks and what's it called? MailChimp? Is it MailChimp? I think it's MailChimp. Things like that. TurboTax, a bunch of other products. So yeah, fintech is one of those areas that I felt had been hit pretty hard by this point, entering the year. So I picked up a little bit of SoFi late last year and a few other positions, including Intuit in Q1. And so yeah, that's now a reasonable corner of the portfolio, but definitely on the smaller end. Semiconductors is somewhere that I've kind of traditionally had a lot of money. This is pretty much always here. AMD, as pictured, is the one that's obviously my largest position. I'd actually decreased my NVIDIA position very substantially in Q3 and Q4 of last year because I wasn't actually too bullish on the outlook for them, especially on the kind of self-driving car kind of side of things and things like that. And in the server kind of space, I think AMD were doing incredibly well on the CPU side. Obviously, in hindsight, I really wish I'd kept some of that NVIDIA, but we still benefited a lot from having AMD in the portfolio anyway. So I can't really be too upset with it. Renewables is another area that really I'm just constantly investing in at this point. So pictured there is one of Vestas wind farms. So yeah, I kind of like to invest primarily in solar and wind. Wind has been not performing fantastically actually for me since I started investing in it. It's kind of been okay, but really hasn't done too well. I think part of that is that it's very European kind of based in terms of the big players in that industry. And generally, the European markets tend to move a bit slower than the rest of the world. But renewables is somewhere that I still hold an awful lot of confidence for the long term. I just don't see it doing anything other than growing at an increasing rate, really. Next up, we have technology and software. So pictured there is Salesforce, but you can lump a lot of things into this. A lot of the companies that I invest in, kind of overlap into that. Things like Microsoft, obviously, you've got the big tech companies like Google and Amazon and things, all of which are in my portfolio at various periods of time. But really, for me at the moment, I guess Microsoft would be the biggest one in that category. Electrification is another big theme that I'm extremely bullish on. So this and it's it kind of ties in with the industrials because most of the companies involved in the space are also kind of industrials, really. But I separated it out because I think there's almost kind of two categories, really. You've got the kind of the big industrial companies that are a bit more like utilities almost, and just kind of slowly generating income. And then you've got the kind of more innovative side of things. And that's really where most of the electrification stuff is. So one of the biggest positions in my portfolio for this category would be something like ABB. I've also got Eaton, which was quite a new addition recently. Schneider Electric as well, which is some of their equipment is in the picture. That was an addition in Q1 of this year. And then last up, the industrials, which is a bit of a broad mix. Things like Veolia, which is pictured there. That's one of their new water treatment plants in Western Africa. They do a lot of waste management kind of things. But there's other industrials I have that are a bit more like traditional utilities. So SSE, for example, is a major provider of electricity and gas in the UK. Moving very rapidly towards renewables, which is one of the reasons that they kind of fit my criteria for being in the portfolio, because otherwise I don't know how comfortable I'd be with a company that is profiteering off gas prices and things at the moment. But they're investing very, very heavily in wind. They're actually the biggest wind investor in the world, I think. So yeah, pretty cool. In terms of performance for Q1, as you can see, there is a bit of a mixed bag actually in terms of the difference between these different markets, right? So I think if we look at the US first, it's pretty clear that the Nasdaq has really run away at an insane pace compared to everything else. It really rebounded hard. I'll talk a little bit about that later. In a couple of slides' time. But really it comes down to the AI kind of boom and also a bit of a recovery for big tech as well. So companies like Meta, for example, were hit incredibly hard after terrible earnings back in Q4, I think it was. It might have been Q3. And they plummeted, their value like fell in half or something like that. A lot of other big tech was really kind of struggling as well, as everyone was making layoffs and things in Q3 and Q4 of last year. But this year the opposite is true, and they've really recovered in a big way. I think probably because their revenue is just that bit more robust than a lot of the economy more broadly. So yeah, they've been doing really well. Small caps on the flip side, as you can see with the Russell 2000, have done really, really poorly this quarter, incredibly poorly, in fact. So I think there's a lot of kind of more innovative and speculative companies out there that didn't necessarily have the healthiest of balance sheets going into this quarter, and they really got caught out when the financial crisis 2, I guess, part 2, started to kind of kick in. And again, I'll talk about that a bit more later. My performance compared to those, I think, isn't terrible. It's definitely not where I wanted it to be, looking at the Nasdaq, which is what I usually like to use as my primary benchmark. So I'm not going to not use it as my benchmark this time. So I guess you can say that I didn't really beat it this time, and was actually pretty far behind it. But again, I think when you actually look at how those gains were really made, essentially the top 10 or so companies, and especially AI-related companies, really are responsible for the vast majority of the gains in the Nasdaq 100 and the S&P 500 as well. But I can't remember the stats off the top of my head, but it's something like 40 or 50% of the S&P 500 is made up now of like the top 15 or 20 companies. So and that's at the S&P 500. For the Nasdaq, it's even more extreme than that. So, really, if you didn't happen to hold Nvidia, then you're very unlikely to have outperformed unless you've found some sort of golden egg somewhere else in the markets. And I had no exposure to Nvidia through the quarter, so that really hit me pretty hard. Looking across to Europe, I think the first thing I'll say here is, before we kind of dig in, is that the numbers below that are in brackets are actually adjusted to be in US dollars, whereas the numbers at the top are just the the rates in the actual currency of those markets. I could probably, honestly, I could probably remove the top number, or at least I should probably switch them around because I guess USD is what really matters since that's what we kind of measure our portfolio in. So I think what's interesting here is that the UK is still struggling immensely, which I put down largely to Brexit. And I don't really see that changing anytime soon. They're struggling with inflation a bit more than the rest of Europe. Although Germany is kind of catching up a bit more in recent months. So we'll see that in the Q2 update, I think. But generally, it's a bit of a bit of a bad picture for the UK at the moment in comparison. That being said, they did still turn a profit for the quarter, which is something that really I think you can only put down to the kind of ongoing revenue that's coming from energy and mining and things like that, which the FTSE 100 holds a lot of those kind of companies in there. Why are we talking Q1 if we're at the end of Q2? Because I'm really, really late. Really, really late at giving this video, this update. Q2 one will probably be in about a month. So yeah, Q2 isn't quite over yet though, so I couldn't be doing Q2 quite yet because I wouldn't have the numbers. So yeah, looking at the DAX 30 and Stocks 50, this is something that I think we'll see reflected a bit in the performance of my portfolio as well. So I think part of what really held my portfolio up during the quarter and helped me kind of attempt to keep up with the NASDAQ 100 was my exposure to some of the big industrials, a lot of which are based in Germany, and a lot of similar companies kind of make up that kind of core constituency of the Stocks 50 and the DAX 30 are companies like Siemens and SAP and stuff like that, which are these kind of massive kind of groups of businesses that cover a wide range of things that are kind of big industrial applications and infrastructure and things like that. So yeah, they did very well. Part of that is down to the electrification trend. Part of that I think is generally the kind of the fact that infrastructure still kind of gets investment when everything else starts falling in terms of maintenance, and there's a lot of maintenance contracts and things in this and kind of replacement parts and stuff. So they tend to do well just because they're kind of necessary to some extent. So yeah, they did well despite the fact that the economy was still kind of a bit more limp. In terms of the trailing 12 months, you can see that here I was much more closely in line with the NASDAQ and the Russell and the S&P actually. So if you this is looking at the 12-month period up until the end of March, so not including the last couple of months. And yeah, you can see that although I am behind the NASDAQ and the Russell 2000 and the S&P 500 and Europe, which is really something that stands out here, but I'll talk about that in a second. I think really I'm actually not too unhappy with that because last year there were some periods of last year where things were not great, and one of those was the month of April, which is the first month in this trailing 12-month period. So that was actually a pretty bad month for me, and that's obviously included in the statistic. And I think if we were to take that out and if we were to shift the whole range forward by 1 month or just do an 11-month range, then probably I would be in line with the NASDAQ 100. So I'm pretty okay with that. I guess the interesting thing here is looking again at Europe. And I think the reason that Europe was so strong in this case was because of inflation and interest rates. So the US was really the first to start moving on interest rates, followed by the UK. Europe and the ECB took a very long time before they started to act, but then when they did act, they've started going quite hard. And so as a result, a lot of this period that is covered in here, Europe was really doing nothing to try and combat inflation. So I think that's quite a big kind of influence on why Europe has done so well here as well. Okay, so some kind of market highlights of things that happened during the quarter. Obviously, AI hype. I don't really feel like I need to spend that much time on it, to be honest. And I was very tempted to write some posts on eToro about AI and my thoughts on it. But honestly, it was so saturated with other people writing content that I didn't really know if I could actually add that much value. But I think there's no denying that things like ChatGPT and some of the image AIs as well, imaging AIs, have really come a very long way in a short space of time, and undoubtedly will be causing some disruption to different industries out there. Really, the big beneficiaries from this so far have been the hardware providers, which is why we've seen semiconductors would do well, and especially NVIDIA, because they tend to be the dominant player in the GPU market, and GPUs are generally what you use to crunch numbers in the way that AI needs it done, at least for the time being. AMD and Intel actually both have kind of pushed down a slightly different path to NVIDIA using FGPAs, which is a different type of processing. And I think they're probably right on that, but I think it's going to take a bit longer to play out. So that's something that I'm kind of waiting for at the moment. And so yeah, I'm kind of happy to kind of just sit and kind of wait that out a little bit. One thing I will say on AI is that I have picked up some other companies that I think weren't really recognized for their AI as quickly. So in fact, very recently I picked up CrowdStrike as a position, which is a cybersecurity company that utilizes AI quite a lot. I still like, obviously, the likes of Microsoft, I think, have been doing really well with AI, and I don't think that has been fairly reflected in the price, considering that they really, were very involved with ChatGPT, especially from quite an early stage. So yeah, I think the mic and looking at how they're planning to integrate it into Azure and Office 365 and things, and even into the Edge browser, if you use that at the moment, you'll see what I mean. Then, yeah, I think they are one of the companies that really stands to benefit a lot from it. That being said, I don't think there's really too much in the way of monetization of AI yet. So that's something to be aware of. We're seeing some really lofty valuations, but if you can't actually monetize it, then it's not really necessarily that great. I guess it can be more of a case of using it to kind of maintain your advantage over the market or increase your market share, which is part of why I think Microsoft are in a really good position. Next up, solar. So the less said about solar, the better. I've got a picture of SolarEdge here, but I think really the one that I should probably have put in was Enphase, which is or was the largest position in my portfolio at the start of the year until their earnings came out, and they gave some pretty poor guidance and some much worse numbers in the US market, especially not so much in Europe or Latin America and things like that, but in the US, which is where the majority of Enphase's sales are based. Really, they started to see the effects of high inflation rates and high interest rates, especially because whether it's rooftop solar or large kind of solar farms, generally speaking, it's a pretty big upfront investment, or you're using finance. And if you're using finance, the cost of money has obviously increased dramatically because of the increased interest rates. So it's much harder to justify building a solar farm at the moment if you've got interest rates at 4 or 5% in some countries than it was 12 or 24 months ago when you were looking at interest rates of maybe 1% or 2%. So as a result, I think that started to catch up with the solar industry a little bit. Those solar panels just aren't going to make as much of a return as quickly at the moment because of that. And so until we start to see those interest rates kind of stabilize and maybe come down a bit, probably the solar industry is going to see a bit of a slowdown in demand. That being said, I think the move on Enphase was really overdone. I think a lot of people put far too much weight on the US market for them when they've been expanding very, very quickly into Europe and into Latin America, and I expect that trend to continue. So yeah, I'm really not too concerned about it. I'm more than happy, especially with the amount of money that we've made off of Enphase up until this point, and off SolarEdge and the other companies. I'm more than happy to kind of wait it out at this point because I'm pretty sure that in a year's time they will resume their upwards trend in quite dramatic fashion, and it's not really something that I feel comfortable trying to time because we just don't know how things are going to kind of evolve in Russia and with energy markets and of course the economy more broadly. So it's very hard to predict what interest rates are going to be in 2 months' time, let alone in 12 months' time. So I definitely don't really want to necessarily reduce exposure because I think that the move was overdone anyway. Um, but I've maintained a lot of exposure to solar, despite the fact that it's been pretty tricky. The other major thing that happened in Q1 was obviously the wave of big bank failures. Credit Suisse, which obviously was bought up by UBS, a hilariously cheap valuation. Essentially, it got subsidized by the governments, but yeah, crazy good deal for UBS there. Although obviously it needed bailing out because the disruption otherwise would have been horrific. Silicon Valley Bank was the other really big one. There were quite a few big ones, to be honest, but Silicon Valley Bank was the other really major one that I think got a lot of headlines, caused a lot of problems in the short term for kind of cash flow issues for a lot of startups and relatively small cap companies that are still banking with them. So that was also had a really big impact on the markets, and I think was part of the reason that we saw the small caps kind of struggle a bit more in Q1. Rate hikes continued. I've got a picture of the ECB on the screen for good reason, because the ECB pretty much went from not really doing very much to suddenly raising rates by 0.5% at a time. And kind of ramping up quite quickly. As I mentioned earlier, the UK is looking at heading towards 6-7% interest rates maybe by the end of this year, which is really pretty wild. I think I saw on Bloomberg yesterday that Pakistan is at 22% interest rates now, or something like that, or 21 or 22%. There's a lot of countries out there that are really struggling with kind of keeping a lid on inflation. I think much like the kind of financial crisis of 2008, 2009, it's going to be a couple of years before we see things kind of fully stabilize. Hopefully we can avoid more kind of bank failures and things. There was a lot of regulation put in place to try and prevent it, but this remains one of the big things that's going to be, something that all of us kind of have to focus on. Mainly me, because I'm doing the investing, I guess, but something that I'm going to have to spend a lot of time on over the next 6-12 months at least, as we kind of see where these things kind of settle down and where the economies start to kind of find some relief. Big tech rebound. So I talked about the AI hype, but as mentioned before, we saw things like metaverse and things do really well, recovering from their big lows. I don't think there's really too much to say about it, to be honest. A lot of companies I felt were undervalued anyway. So Salesforce, for example, is one that's in my portfolio. It's always been quite a small position, but they jumped up pretty dramatically. Were definitely one of the best performers in the quarter. There are a few others that did well in the tech sector as well, but I think the one that most people think of is Meta. And then the last image here that I'm sure will make lots of people happy is that the crypto bear market appears to have finally ended, and I think mainly Bitcoin, honestly, but some of the other altcoins as well have kind of rallied up pretty significantly actually in Q1 and through into Q2 as well. So things are looking a bit better for crypto. I still think that I feel like this time is a bit different in that I suspect we're going to see a lot less altcoins kind of rally. And I think the kind of hype that we saw around NFTs and DeFi and, smart contract stuff generally and ERC20 tokens generally that we've seen in previous kind of rallies is very unlikely to occur to the same kind of extent. I feel like the market has matured a bit and realized that, just because someone has a nice logo and kind of says they're going to do X, that doesn't mean they're actually going to do X. So I think probably it's going to be a much more consolidated rally among the top, 5 or 10 cryptos, generally speaking. Okay, so in terms of some actual highlights, for my portfolio in terms of trades and lowlights. I don't just like to show the good stuff. Sometimes I like to admit defeat as well. First off, fintech wins. So I mentioned it a bit earlier. SoFi is a position I picked up in, I think it was November. They had a really, really strong Q1, up by some 30% or so. Since then, they actually rallied quite a bit higher as well. So they've done very well for me. Intuit is a position that I built early in Q1, as was StoneCo, or I think I did a bit of StoneCo in Q4 as well. StoneCo didn't do amazingly, and Intuit did okay, but spoiler alert, in Q2 they both did very well, especially StoneCo, which rallied dramatically, and SoFi also rallied very high as well. So I've taken some profits from SoFi already. I think I took a little bit of profit from StoneCo, and I'm kind of still monitoring the sector. But those companies I felt were massively undervalued going into the year, and despite the kind of drama in the financial sector, they managed to come out pretty strong from Q1. So that was great news. I think, I've already talked about solar, but I may as well kind of go through it again. Really, the companies that struggled most here are the ones that were the most US-centric. And I did have quite a lot of exposure to Sunrun, SunPower, and Enphase. So those guys tended to do a bit worse. Jinko Solar actually posted quite a good Q1, but then their Q2 was very bad, and their guidance from Q1 was relatively bad as well. I think it's just one of those things where I think the safest thing to do, generally speaking, is wait it out. That being said, I did, after those earnings from Enphase, so before Sunrun and everyone else had reported, I cut my position in Sunrun entirely because they were the people I felt were most at risk from the kind of inflation impact. SunPower I cut out dramatically, and Jinko Solar I think I finished closing that out fully just last week. So generally don't have too much exposure to solar now. I still got a lot of Enphase and a lot of SolarEdge. As I mentioned, I think Enphase was overdone. I did some leverage trades on it actually after earnings, and I had to wait a couple of weeks for it to play out, but that actually made back a little bit of the loss for us in kind of a short-term trade. Industrials, the momentum in industrials and electrification has been immense. ABB, Eaton, Schneider Electric, Siemens, they've all done incredibly well for me over the past 6 months, actually. So not just in Q1, but also in Q2. I think it was ABB that probably made the most, or possibly Eaton. That really helped my portfolio a lot, because I would say that something around 15% of my portfolio has probably got exposure to that sector. So that really helped kind of balance out the portfolio and do well. And the great thing about this is that these aren't traditional growth kind of industries. People generally see these as slightly more stale companies that you kind of use as your more defensive positions. And actually, I had to even justify to eToro. At one point, they asked me if I was changing strategy because I was putting in these companies that had traditionally lower kind of risk and lower reward. And I had to justify to them and say that I still kind of view these as actually growth companies at the moment, because they're doing so much around kind of smart grids and some of the new kind of stuff, equipment that's coming out to help manage electricity networks and everything kind of surrounding that, really. So really, really happy with how that sector has gone for us. Small caps have struggled, so I've got a picture on the screen of Coinbase because they were one that didn't. But generally speaking, small caps have really struggled. Coinbase, I fortunately saw before earnings that there was a chance for them to do really, really well. I invested before their earnings, and it was an absolute explosion. I think I made 60% or something in a week, which was really, amazing. But unfortunately, of course, it was a reasonably small position, so in the grand scheme of things, it doesn't help too much. But really here was a case of, going through all of my small cap positions one at a time, really, and kind of evaluating them and deciding, do I want to cut from this now, or do I want to kind of hold, and do I still have confidence that these guys are going to recover and can survive, the current economic climate. So some of the ones that I cut, for example, were ChargePoint, which from their latest earnings looks like it was a good decision. Plug Power as well. I had started cutting that early, and then I finished cutting that. I had a very small position left, and I cut that out fully in the end. Peloton is one that I picked up because I thought it was a bit undervalued. Since then, it has proven me wrong and has continued to decline, but it is one that I still think should survive this. And if it does, then it will be in a good position. Sunrun, I mentioned earlier. Lovesac is another one that I think really the market just kind of misunderstands. The demand has decreased, but they're still outperforming all of the competitors in the space and kind of maintaining position in a pretty good way, and have got a healthy balance sheet. So, it's been a lot of work, honestly, keeping track of all of these the small cap companies, especially. And making sure that they are kind of suitable investment looking ahead. Looking towards the future for 2023, I didn't do Q2 because Q2 is almost over. I could have looked like a genius, right? Pretend that I'd written it ages ago. But no, I've decided to be a bit broader. So interest rates, I think that in the US, things are starting to kind of reach a plateau and slow down, coming in for that soft landing, as people keep saying. And I think that the US is in a pretty healthy position overall financially. So I expect the US market to recover first. And I think really we've already kind of seen that. And part of that, I think, is massively helped by, the prevalence of tech companies and AI and all of those big kind of trends in the US market. So the US market, I think, is the place to put your money at the moment. For Europe and for the UK, it's not quite so clear cut. Europe has still got some really great companies, and I think companies like ABB are a good example of that. But I think it's one of those situations where you really have to spend a lot more time considering currency risk as well, and what's going to happen with that alongside interest rates. So that's making things a bit more difficult. The UK really is the one that I see being the biggest problem there now. I just think that the UK needs time to politically kind of change direction regarding Brexit, because I just don't see how they're really going to fill this big hole of money that's missing from the economy since Brexit's happened. And the level of strikes and protests and things that we have in the UK, in terms of like sentiment and like, I guess, the morale of the population is really a pretty low point. Whereas although, the French, for example, have also been protesting a lot, and actually a lot of countries in Europe have been, I feel like the situation in the UK is in a slightly worse position just because of the finances of the actual country itself. So the UK is, I think, one of those markets where unless you've got something really kind of solid, it's going to be one that's harder to justify investing in for long term at this point. And I plan on making some more decisions around that coming up. So there's a few companies that have been in my portfolio for a long time that I was really happy with, but I think reevaluating with the kind of mindset of the currency risk and the risk of regulations and political risk and stuff as well, it may no longer necessarily be worth me holding on to some of those. So probably I'll be reducing exposure to the UK as a result, because I can only really see that getting worse through 2023. Semiconductors. I wrote an article recently about AMD, Intel, Samsung, NVIDIA, the whole lot really. And I think it's a fascinating sector. But I think that when I look at valuations, it is harder to justify investing in NVIDIA, which is why I was doing it with a kind of a hedged approach, putting some money into Intel as well, which tends to move in a slightly opposite direction with a lot of the other semiconductors. I think NVIDIA's valuation is pretty steep at the moment. And it's really quite hard to justify investing in that now. At the same time, both AMD and Intel are still, pretty early in terms of AI, in their product offerings. So, you're not going to see the same kind of boom in those until those mature. By which point, who knows how much more market share NVIDIA perhaps have got. So it's an interesting sector at the moment to be looking at. But overall, I still think it's a big growth sector and is likely to continue doing really well. I think we're probably in a position where the risks in Taiwan have kind of subsided a little bit. Um, but either way, I still think it's something that needs to be considered when you're investing in this industry, which is why I think having Intel and Samsung is a nice kind of play. And I would also point out that Samsung's got some cool technology as well coming up that I think will give them not necessarily a lead or advantage, but I think will solidify their position as like the second player behind TSMC in terms of their chip design, really. Ukraine's counteroffensive, I think, obviously we're still pretty early in it at the moment, and there's been a lot going on with Russia over the weekend, last week. But I think we're in a position where by the end of Q3, we should have a pretty clear picture of how things stand. There's still a lot of risks here. I really can't talk about them too much because I would be here all day. But I think that there's definitely a high chance of some big volatility in oil and gas markets, some of the mineral markets, uranium markets, anything really that's heavily impacted by these areas, and as such, food prices as well, because Ukraine and Belarus and southern Russia are kind of like one of the bread baskets of the world, really. So, whatever happens there, I think is going to make quite a big impact on inflation and on the economies of other countries that are kind of reliant on some of the exports from that region. So it's one of those areas that I think is just something that we still need to pay a lot of attention to. I'm pretty optimistic that Ukraine will kind of slowly take back a good chunk of land before winter kind of sets in again. As for what happens with Russia, I think it's incredibly hard to really say, but certainly it does look like Putin's been weakened quite a lot by what's been going on. So yeah, something to keep an eye on. Also, I just realized that I never actually changed the icons for these, so I've got some completely unrelated things here, like an electric battery symbol next to Ukraine's counteroffensive for some reason. So ignore those. Probably nobody noticed until I mentioned it. But okay, that's it for now. Before I start answering some questions. Please make sure that if you're following me on social media, that you are really following me. Sorry. Yeah, please make sure that you're really following the real me and not a fake me. There are lots of fake me's around. Twitter has actually been pretty good at deleting them recently. Since eToro made their kind of partnership with them, I think they've got some like super duper prioritization, and Elon's personally saying delete the fake J's. So if you see a fake J, please report it. You don't really need to tell me because generally speaking, they have me blocked, so I can't do that much anyway. But yeah, by all means, feel free to report them wherever you see them on social media. My name is Jaynemesis basically everywhere. If it's not Jaynemesis, it's probably not me. And if I have DM'd you out of the blue about some amazing new investment opportunity, you can pretty much bet that it's not me because I really don't have enough time to DM all of my copiers about investment opportunities. And also, I don't know why I would really, because copy trading is the best way really of getting exposure to what I think. So, with that said, I'm jumping into some questions. I'll go back through and scroll up and try and answer from the top. I see there's a few in there already. But if you haven't asked it yet, or you have another question, feel free to ask. And if you're joining late, once the live stream is finished, I will be uploading it. Well, it will be already uploaded, I guess, to YouTube, so it should be available pretty quickly. I might need to edit it slightly, but just to get rid of the kind of waiting time at the start. But you can feel free to rewatch it if you missed anything. Okay. Let's see if I can find the first question. Do you think we'll see another bull run from Polkadot in the next 2 years, possibly a new all-time high? That is a good question. I really like Polkadot, but I'm generally a bit more bearish on crypto as a whole. So all-time highs, I think, is possibly a bit of a stretch. I'm just looking at the chart now. Here you go. You can have a look with me. Let's hide that. Yeah, let's have a look. I mean, it's been a pretty horrible drop, hasn't it? I think it is due a rally at some point, but I think it's hard to tell with crypto. To me, it feels like there is a real kind of sentiment shift in the mainstream now about what crypto is really useful for, and people are starting to ask the question, where are all of these awesome use cases that were promised to us? And I think until we start to see some of those in terms of the kind of application side of it, which isn't really what Polkadot does, the entire ecosystem will struggle beyond the top couple of coins. So I think, Bitcoin and Ethereum, I think will rally pretty happily. But I think everything else really is waiting on some of the technology built on top of Ethereum, and its kind of, surrounding chains like what's it called? I forgot its name now. Polygon, Matic. If people are building cool applications on top of those sorts of things that actually really have real world utility, at that point, I think we could start to see some of the more kind of infrastructure based stuff like Matic and Polkadot rally more. But generally speaking, I wouldn't be betting too much on it. Personally, I would say that you really, really, really need to keep your money kind of associated with the big coins overall, and keep the more speculative positions a lot smaller in crypto. I removed my exposure to crypto in my portfolio entirely. Even though crypto has had a decent rally this year, I still think that was the correct decision, because ultimately, for the amount of risk that you're taking investing in crypto, when you look at that compared to the returns that you could get from investing in some big tech companies instead, whether that's Tesla or Nvidia or Microsoft or Google, the risk to reward just doesn't make sense for putting the money in crypto at the moment, I don't think. So keep that in mind. I don't want to be too pessimistic. I do think a rally is on the horizon for a lot of these things, including Polkadot, but in terms of all-time high, I'd say that's a pretty big stretch. I don't see that happening this year, certainly. Not for the altcoins, at least. And honestly, probably not for Bitcoin or Ethereum either. As your largest holding is Enphase, why do you think the stock has dropped 37% year to date? The financials of the company looks good, but what factor is worrying investors? I think I think I covered it a bit earlier on. I don't know if you're still here, Coach, but probably you heard me talk about it a bit earlier on. Really, it comes down to the guidance that was given during that quarter, and looking and kind of extrapolating from the US data and assuming that that's going to happen in Europe and Latin America and everywhere else as well. When I don't think that's necessarily true. I think there's some other factors that you really need to consider with solar as well. So while it's true that solar itself is struggling, I think the usage of home batteries in the US is still going to grow because of the problems that they've had with blackouts and things like that in the recent years. And the other thing is that I think that solar is a product that makes more sense the more electricity you're consuming. And in America, that really comes down to, if you have an EV, you should probably get solar. In Europe, it will come down to if you've got an EV and if you've got a heat pump, which are both things that a lot of people are starting to invest in now. Then you will want to get solar, because it makes those things even more cost saving and even more economical. So I think it's a bit of a stretch to say that, it's just going to be doom and gloom now, and nobody's going to be buying solar because interest rates are high. But at the same time, I think really it's still going to be less than what it has been in recent years. And Enphase has had a particularly good growth rate over recent years. Like I think on average it's like 100% a year or something crazy for the past like 3 or 4 years, somewhere around that kind of region. And obviously that's slowing down now, and people had valued in that happening, and now that's going to be a bit slower and a bit more delayed in terms of when it happens. But Enphase is pushing out into other geographies, so that may help them a bit, especially when you consider that countries like Latin America and South Africa, a lot of Europe aren't don't have as much solar as the state of California, which is quite well saturated really at this point. So yeah, there's still good opportunity there. There's still a lot of other things that I'm really bullish about with both Enphase and SolarEdge, which is the way that they're kind of building this sort of building themselves as a kind of supplier for the grid, and kind of, I guess, bringing in all of those different resources of everyone that's got home batteries and solar and stuff, and kind of selling that as a service to grids around the world, to try and help load balance the grids, which is going to be even more important as there's more and more renewables on the grid. So yeah, generally speaking, it's probably going to be a bit rubbish for the next year compared to normal. But that doesn't mean it's not going to grow. I think it will still grow. It's just not going to grow as quickly. So probably at the end of the year, maybe we'll end up where we started the year, which isn't great, making 0% on it for the year. But at this point, after the 37% drops happened, you might as well kind of just sit and ride it out, because I think you've got a pretty good chance of it rallying through that time, especially if interest rates in the US kind of stabilize as well. Then Enphase especially should do a bit better out of that than SolarEdge would. Okay, next question. NVIDIA had an amazing run this year. It's probably overbought. You still hold 1.84% in your portfolio. Do you expect a retracement? Do you consider closing some of your position? The position's so small that I don't really feel any need to close it. And as I mentioned, as I mentioned earlier, and in my article that I wrote about the semiconductor industry, it's kind of hedged by the fact that we've got Intel in there, and Samsung. So yeah, I'm pretty comfortable to just kind of cling on to it for the time being. I do think that while it seems like an insane jump, and on top of the insane jump in terms of what was in NVIDIA's earnings, the price of their share has increased by more than that, really, to try and price in future growth. I think probably investors are generally right on that, and that there will be a lot of money flowing in the direction of NVIDIA. Something that was kind of interesting about their earnings that I think a lot of people just ignored because they were so excited about the AI side of things is that the gaming revenue at NVIDIA actually dropped for the quarter by a pretty big chunk as well. So that's something to think about, especially with Intel still kind of building out their GPU side of things as well, to perhaps try and compete a bit more in that realm. And then obviously, we have seen AMD and Intel and Samsung and everyone else under the sun that makes a semiconductor trying to point out that they also have an AI roadmap. Ultimately, they're all going to be later to market and in lower volumes than NVIDIA are. At least if people still keep using the same kind of GPU-based compute architecture. But if that changes, then Intel and AMD could do really well out of it. So there's a lot to discuss there. But yeah, I'm not really worried about changing my position size in NVIDIA now. I'm pretty happy with where I put it. I only actually added a lot of those positions relatively recently. So, do you think the hype of crypto and retail investors that occurred during the pandemic will return anytime soon? That is a good question. Yeah, it's a good question. It's I can't rule it out. I thought at first I was thinking definitely not, but ultimately I think the kind of culture that's been created there, and just the difference in like the younger generations, especially in a lot of the developing countries now, I say developing. I hate the word developing countries. Like they're just normal countries, really. But if you look at countries like Indonesia, the Philippines, like Southeast Asia, especially, but also a lot of Latin American stuff, like people are kind of, you know, those countries are a little bit kind of delayed behind Europe and the US in terms of kind of like spawning these sort of digital nomad type people that sort of live on the internet and have access to everything. But it is happening now in those countries as well. So when all of the citizens of Brazil and of the countries in like Nigeria, for example, when people in those countries start getting access to markets, I think with the internet being the way it is and the way information is these days, and the ease of access, we could well see another hype cycle. Whether or not that hype cycle is going to be the same as what it was, I don't think it's going to be as big. And I don't really expect it to be in crypto as much. But I do think that we will see it in stocks again. I'm pretty sure that we'll see it in stocks again. When that is, though, I don't know. Maybe a couple more years before we see that. Once things have turned a bit more bullish and interest rates come down. But I think also, to some extent, it will be a necessity. As I mentioned earlier, the interest rates in some countries, look at like Sri Lanka and, as I mentioned earlier, like Pakistan and stuff, or Argentina. These people need to invest to protect their wealth. And so, I think when those products make it available to them, they're going to do exactly that. And that will in itself kind of create a bit of a hype cycle. How's your opinion on AI-related stock and the future of cloud gaming? Do you intend to invest in it? Cloud gaming is an interesting one. I'm still holding a position in Activision Blizzard because I still expect that Microsoft will eventually be successful in acquiring them. And I'm also incredibly bullish on Microsoft's technology in terms of streaming. I also hold quite a lot of Sony for a similar reason. Sony aren't really innovators in this space. I would say that they are definitely the laggards, even though they are the big player at the moment in terms of users and all the rest of it, and the kind of size of their gaming business. But I don't think there's really any startups or anything that I'd be looking at. I mean, you could look at things like Nvidia, but generally speaking, I would say that Epic Games is the one that I like the most in that sector. Even in terms of like as a metaverse player as well. But yeah, for cloud gaming, I think Microsoft's probably the easiest play to take and the safest. Sony is a bit more risky because you've got a lot of currency risk with Sony and a lot more kind of diversification risk. Like they make products that are physical products, whereas Microsoft doesn't really. Margins on those are a lot lower. They've even started working on cars with Honda. So, the margins there are a bit more risky, and investing in that business is a bit more risky. But generally speaking, I think that it's definitely something that we're going to see happening over the course of the next couple of years. Live streamed games, especially now that Google's Stadia has kind of collapsed in on itself, which I think was always inevitable from the start. Something that I talked about when they first launched it. Just got out of work. Did I miss anything big? Well, you probably missed most of the presentation, but you can watch it back. So, bonds feel interesting lately. What are your opinions? Yeah, I think bonds have been. I think bonds have been increasingly interesting to a lot of people over the past year. Really, haven't they? Normally, they're kind of seen as the unsexy thing, but all of a sudden, everyone's like, "Ooh, you can give me a yield of what? Did you say?" Yeah, bond markets are interesting. I think there's definitely potential in. I would lean towards looking at the European kind of bond market at the moment, because I feel like the US is looking like it's going to stabilize. The UK is looking like it's too unstable. Most of the rest of the world is generally not really going to go too close to, I don't think. But definitely, I feel like Europe is the one that's interesting, and I think it is about probably looking at the 2 years and trying to look at the 2 and 10 year kind of curves and trying to time that a bit as is a potentially decent option. I mean, depending on your risk appetite, I think there's always a place in a lot of people's portfolios for inflation linked bonds as well. To be honest, because it's just an unpredictable environment at the end of the day. And if inflation is and if interest rates are sitting at 5% or something, and the S&P is likely to return you 7% a year on average, then you got to ask yourself, why are you bothering taking the risk when you could just hold bonds and get it guaranteed, and just kind of maintain your value a bit more easily. Bonds isn't something that I really specialize in, though, to be honest. So I'm probably not the best person to ask on it. But I agree with you, at least, that it definitely feels more interesting lately. I would agree with you at that. I find myself looking at them much more than I used to, that's for sure. Even though they're not really featuring in my portfolio. So, do you think trimming down tech position at this time is a good idea, as Nasdaq has gone up 30% already year to date? I think you've really got to weigh up the individual company, to be honest. I don't think it's as easy as saying that you should do it with tech generally. And if anything, I think that there's a lot of tech that has been overshadowed by what's been going on in AI. And even some of the stuff in AI, I talked about some of the image-based AI. I think Adobe is a pretty reasonable valuation. To be honest, I've been adding to it over the past few days, increasing my position there slightly. As I said, I wouldn't be probably putting money into NVIDIA unless you had zero in it. I still think that even at this point, if you've got nothing in it, it's probably worth putting a tiny bit in it just to protect yourself from the upside risk, I guess, the risk that everyone else is right and that it is going to continue kind of mooning. So you got to think about that. I mean, ultimately, I think part of the reason that I've underperformed the Nasdaq in the past quarter or two is the fact that I didn't own much of those really, really big top end big tech stocks like Google, Nvidia, Amazon, Microsoft, Apple. I had a lot of Microsoft and I had a little bit of Nvidia and AMD, but that's really it in terms of my exposure to those really, really big names. And so that ended up hurting me because all of them done well. I mean, I'm actually pretty bullish on Google at the moment as well. I think if you look at the kind of live streaming world at the moment, I think Twitch is starting to struggle a bit with the competition coming from Kick and stuff, and YouTube. At the end of the day, I'm streaming to you now on YouTube, not on Twitch, and I have been on Twitch all of this time. And I think there's quite a lot kind of developing in that space. And if YouTube can continue to kind of grab that market, and I think even if you look at their shorts and stuff, while they haven't obviously taken over TikTok, I think it has been reasonably successful for them. And obviously, Google is a really big company that does lots of other things, but from that segment at least, I'm pretty bullish on the outlook for them. So, yeah, I think big tech is still looking pretty good, to be honest, even though it's gone up 30%. At the end of the day, it did get hit really hard last year. So it's not too surprising to see it come back, especially because of the AI theme and also the kind of necessity of a lot of businesses to continue spending on their technology stack. Whether it's the software they use and things like Salesforce and Slack and all of those sorts of things, or if it's the hardware side of things and compute resources at servers and stuff like that. So yeah, I wouldn't necessarily cut it too much. Definitely, if you've got a lot already invested, then consider taking some of that profit and putting it on the sidelines. But if you're not exposed to it already, then I think you could end up being at risk of kind of holding out, thinking it's not going to go higher, and then it might prove you wrong. Are you familiar with CSPR? Is that CRISPR or is that CRSP? I think that's CRSP. Probably not. In that case, I'm not sure. CSPR. No, I don't think so. Unless that is CRISPR. In which case, then I am familiar. Yes, it's a pretty interesting sector actually. Generally, gene editing and stuff like that is a pretty interesting sector overall. So one of those themes that I think eventually should see a good run. In the same way that I think if you actually kind of take a step back and look at some of the things that have happened, that some of the hype areas of the market over the past 3 or 4 years, I think there's quite a few of them that people have kind of forgotten about now. And if you go back and you look at them, there could well be some interesting plays there. So, for example, I think, and I haven't even really looked at this too much myself, but I think the marijuana sector could be interesting at this point. Nobody's really talking about it too much. I think LiDAR could be interesting. 3D printing could be interesting. Again, I'd need to double check and actually look at these and see if there are actually real good opportunities there. But I think that there's a lot of sectors that have kind of just been forgotten about by the market at the moment that you could go back to and actually find some pretty interesting companies in. Do you think that with cryptos, the key point is that the majority of people prefer peace of mind? I'm not really sure what it's referring to, really, I guess. I think at this moment in time, it's definitely a risk-off environment, though. So you've got to ask yourself if, at a time like now, if you can afford to be putting money into these kind of big YOLO plays like crypto, especially when you're looking at the market and you're seeing that things have fallen by 80% plus in the past, year or so. Casper Labs, yeah, I did wonder if it was Casper, but yeah, I'll read that in a second. Otherwise, I'll distract myself from the question I was just answering. Key point is, do they prefer peace of mind? Yeah, I think it's, as I said, I think it goes back to the conversation I just had about bonds from the question that came in earlier. Bonds are looking more and more attractive to people because, you've just got to ask yourself, really, what are you taking this risk for? Like, how likely are you really to make a return at this point while the market is like this? And how much can you afford to risk yourself anyway? Like, when do you need that money by? What's your time horizon? If you're young, then now's a great time to just be YOLOing money into random stuff. And then hoping that in 5 years' time it goes a few of them go boom. If you're a bit older, I think you've got to be more cautious than that, really, because ultimately you just can't afford to risk losing too much of your savings. I think biopharma and biotech are looking like great buys at the moment. Things like Immunity Bio, VBI, vaccines. I'd love to hear your thoughts on this if you have any. Medtech and biotech generally are kind of areas that I tend to kind of steer away from because I think it's difficult, right? Because you've got things like, I'm super interested in some of the stuff that they're doing. So like some of the Alzheimer's drugs that are being worked on at the moment, they've got, I think, stage 3 trials now by different companies. And as I mentioned earlier, some of the gene editing things look amazing. There's just a lot of really, really cool, interesting innovations happening in those areas. I think the problem in terms of investing there is that you're very much at the whims of, especially if you're doing it in the kind of in those kind of medicines that are going through their trials. It really does come down to how do the results come out of that trial. I'm sure I saw a study a few weeks ago that came out and like 9 out of 10 of the patients showed massive side effects, and it basically just killed the stock. They were riding on this drug, and then they got to their next round of testing, and everything went bad, and that was that. It was kind of dead, right? So I think in terms of the really kind of small cap stuff and that side of things, it's a pretty risky area to be investing in. But generally, there's a lot of innovation there. So I think actually maybe even like an ETF or something like that to get exposure to it might be a good idea for a lot of people. Again, it's one of those areas that I don't have enough knowledge on really to give too much of an insight. So if it was me, that's probably the approach I would take to it. At the moment, at least, while we're kind of in this sort of economic environment that we're in. But yeah, it's definitely an interesting place to look at. I know that there is a popular investor on eToro. I think his name is Simone Riz something. I think he's Italian, off the top of my head. And I know that he has that background, and he invests very, very heavily in that space. So yeah, if you haven't had a look at him, then maybe take a look at him on eToro. He's quite a good, knowledgeable person on that side of things. I'm sorry I couldn't really give you anything more than that, really. I said that I would read your latest things. So Casper has Casper Labs, Ethereum devs who left to make effectively better. Oh, Casper, yeah, I know now. Lots of institutional backing, notably the World Economic Forum. That's kind of interesting. Didn't know that. But I think the next Ethereum, quote unquote, has kind of had its day now. Like we saw the wave of like Cardano and EOS and all of that kind of stuff, and then you got a bit later and you kind of had the kind of Polkadot and Matic and all of the kind of fork chains like the Binance chain and Crypto chain and all of that kind of stuff, Crypto.com. Simone Rosetto, yeah, that sounds correct. Yeah, I think that's him. From memory, looks a bit like me, bald head, a bit skinnier, a bit healthier looking than me. Maybe because he invests enough in that sector to kind of know what's going on. But yeah, he kind of specializes in those two sectors. So I think he's if you want exposure to it, then I think he's a good person to go to. Obviously, please actually do some research and check him out yourself. Don't just take my word for it. Generally, I don't spend too much time looking at other popular investors on eToro because I invest my own money. So, I tend not to copy people really. Just checking to see if there's any other questions really. Investing on OpenAI coins, example render, opinion on Activision and Microsoft. Okay, so AI coins, I wouldn't go near them, to be honest. I just don't think it's worth it. You're way better off just investing in, the picks and shovels, right? So companies like NVIDIA, or going with someone really, really big that is going to make utilization of AI itself, like Microsoft or Google. Opinion on Activision and Microsoft. Yeah, I mean, I think that it's insane that Sony has managed to delay this so long. And I think that the UK will eventually kind of almost be forced and pressured into following what everyone else has done. The fact that the EU managed to approve the deal kind of, to me, signifies that it's a pretty reasonable deal and Microsoft is being reasonable. And so if you want some kind of easy-ish, in my opinion, upside, a bit like when Twitter was acquired by Activision, right? Because I'm pretty sure off the top of my head, the price was like $90 a share or something that they were offering. So, I'm not sure what the price of Activision is at the moment, but it's some decent upside. And I don't see it not happening at this point because of the fact that, most jurisdictions have approved the deal now. So, yeah, I would say it's a pretty nice option. I was more referring to the fact that people keep their coins in cold wallets than exchanges. Basically, if they need someone manages their finances. Yeah, I mean that is a good point, I guess. I don't know though. I feel like the the implosion of Sam Bankman-Fried's empire still sits very firmly in the minds of most crypto investors, and probably they're going to kind of remain in self-custody for the most part, or they're going to use really big players like Coinbase, perhaps. As I mentioned before, Coinbase had a really, really good quarter at the start of the year, so I think really that was all a big opportunity for the likes of Coinbase to try and solidify their position as the dominant kind of market player. I mean, shout out to some of the other exchanges that have been really solid for a really long time, like Kraken, right? They've existed for absolutely ages. One of the oldest exchanges in crypto, and they're still going strong and haven't imploded or done anything crazy. So, there are good exchanges out there. But yeah, I guess there is kind of more potential for some interesting products there. But I guess this is where DeFi comes in as well, though, because if you can self-custody and then still kind of get exposure to interest yielding products and things like that through DeFi, that's pretty interesting. I guess that DeFi is still, for me, I think, the area of crypto that holds quite a lot of potential because of that. Okay, I'm going to make this the last question. What do you think of Carnival Corp's recent run-up? I haven't looked at it, to be honest. To be honest, the last time I looked at it was during the pandemic when they absolutely fell off a cliff. And yeah, looking at it, I'm not surprised they're having a run-up, to be honest. I mean, they've been rock bottom. It's kind of crazy that they've been that rock bottom for that long. I kind of tempted to look at the financials for them. It's not necessarily the kind of company I would invest in because I don't think it would really pass my ESG criteria of, is it, well, I say my ESG, my ethical criteria of, is it actually good for the world? Having a skyscraper sailing around the world burning lots of fossil fuels to take people to places that used to be kind of natural and polluting them. It's kind of hard for me to justify it personally. But maybe I'm wrong. Maybe they're doing some interesting stuff in terms of offsetting and all the rest of it. But yeah, it's a pretty interesting chart. That's definitely an interesting chart. I could see why people would be investing in it at the moment. Again, pending, I haven't again looked at the financials for them, so I can't say that too much. But yeah, it's worth taking a look at. Increase their tickets by 30%. Wow. Some people got money to spend. Okay. I think I've kind of covered off all the questions now. So with that said and done, this kind of turned into like a bit of a Q&A stream as well at the end because I'm not really doing Q&A streams now. I'm still thinking about doing them half yearly, but we'll see. Maybe I'll just start doing this and kind of just include it on the end of these a bit more. But thank you all for joining me. If any of you are late and you missed it and you want to go back and watch it, you can do so because it will be available on YouTube shortly. That's it, I think. Thanks for watching. You can find me on eToro at etoro.com/people/Jaynemesis if you want to copy me. Yeah, I look forward to the next one. Hopefully it won't be as late as this one. Thanks for copying, everyone, and I will see you next time.